Good afternoon, everybody, and thank you for joining us in our webinar today. I'm Michael Boutzoukas. I'm a shareholder with the firm of Becker and Polyakoff hosting this webinar today. Becker is a full-service commercial law firm with offices in Florida, multiple locations in Florida, as well as locations in DC, New Jersey, and New York. For nearly 50 years, our focus has been utilizing the skill sets of our experienced attorneys to come up with innovative thinking and really relentlessly focus on our clients' needs and approach things in a way that will help them strategize and develop their business objectives and their legal requirements and legal needs. Our goal is to help them move forward at all costs, and we find a way to make that happen in all that we do. I'm in the real estate department of the firm. I primarily practice in the area of commercial real estate, representing clients in a variety of different aspects from lending to acquisitions and leasing, oftentimes working on matters that are a little bit unique and innovative and different than a typical transaction you might see. We've worked hard on putting content together today, and in doing so, we kind of looked back at the previous seminar that we held in May, where we had a panel and asked what would be coming next after COVID, to kind of look ahead. And the general conclusion of our panelists at that time was a combination of not really having a clear identification of what could happen next, because there was a lot of questions outstanding, especially what would come of the expiration of the PPP loans and how those were requiring employers to keep people on their payroll through the end of June, and wrapping up commercial lease negotiations that were underway for either abatements or deferrals of rent, and the uncertainty of how the phased reopenings would go. All suggested that July might be a better indicator of how things were going to be going, and we saw all the setbacks with the phased reopenings, the spikes in the COVID positive cases and deaths and hospitalizations, and all that is having a continuing trickle-down effect that's impacting the commercial real estate segment. Now that we've seen how those have panned out, we want to come together again and talk about how much worse, or will they get worse before they get better? Are we on the mend already? And look at some of the factors in the different real estate sectors that might be important to you to hear about, and that you can then employ and consider in your business planning and strategy. To discuss these issues, we brought together a great group of industry leaders to share their insight and consider questions of whether these things will get worse, and perhaps for how much longer. Our panelists include, and I'm going to go through them one by one and ask them to briefly introduce themselves and who they're with and what they primarily do in their business. And I'll go through them alphabetically for you. Lloyd Berger, welcome today.
Yep, we're Berger Commercial Realty. We manage and lease and broker properties throughout South Florida, manage about 8 million square feet.
Excellent. We also have with us David Bevirt. David?
Michael, thank you. Dave Bevirt, Executive Vice President of Corporate Leasing and Strategy for Strategic Property Partners. We're the operating and development platform on behalf of our investors, which are Cascade and Jeff Finnick, in the development of Water Street, Tampa, 9 million square feet, a $3.5 billion investment on behalf of our investors.
Excellent. Thank you for being here today. We also have my partner, David Blattner, in our Fort Lauderdale office. David?
Hi, I'm David Blattner. I am a real estate shareholder with Becker in Fort Lauderdale. And like Mike, I represent developers, lenders, investors, landlords, tenants in all sorts of real estate transactions. The short way to put it is I'm a problem solver working for my clients. And in this age of real estate, a problem solver is a good thing to be.
Excellent. And we also have with us Omar Franco, who's in our DC office. Omar?
Hi, Omar Franco, and like Michael said, I head up our DC office. I was the chief of staff to Congressman Mario Diaz-Balart. I've been up here for 17 years now, and we represent associations. We represent a lot of county governments, such as Palm Beach County, Collier, Sarasota, Brevard, Volusia, and we represent a lot of corporations, and specifically in real estate, we are with the National Association of Hispanic Real Estate Professionals.
Thank you, Omar, for joining us. And last but certainly not least, Jason Hochman. Jason, good afternoon.
Hi, Jason Hochman. I'm with Cushman Wakefield. I'm in our capital markets group. I'm a partner on a 9-member statewide team. My 8 partners focus on investment sales of office and industrial properties, and I am the mortgage broker on the team focusing on placement of debt for all asset types.
Excellent. Well, appreciate all of you joining today and sharing your insight with everyone who's listening in as attendees. To kick things off, I wanted to go back to Omar first. There's obviously been a lot of talk in the press, and there was a self-imposed, not really binding deadline of tomorrow to try and figure out what they're going to do in terms of additional stimulus. Omar, what are you seeing in DC, being on the ground up there?
Well, right now it's down to 4 people are negotiating. So you have the Treasury Secretary Mnuchin, the White House Chief of Staff Meadows, the House Speaker Nancy Pelosi, and Senate Minority Leader Chuck Schumer. So they're the only ones negotiating right now. The House put out what they called the HEROES Act. On the HEROES Act, it was a $3 trillion package. In there was an eviction moratorium, good for 12 months. In the Senate, McConnell came out with what they are calling the HEALS Act. And then in the HEALS Act, there was no mention of the eviction moratorium. So that's kind of where we're at right now. Right now, as you said, it's a self-imposed moratorium of the end of the week. We are all hopeful, but we know that they remain really far apart. Unemployment insurance compensation seems to be the holdup right now. It's, that the $600 extra, the length of time, just other things. One last thing I will say is that President Trump currently right now has ordered his staff to start drafting up executive orders on the unemployment insurance extension, a student loan moratorium, eviction moratorium, and payroll tax cuts. So if no deal is reached by tomorrow, we expect the president to try and do it on his own. How legal that is, we will find out, through the courts, I think. But that's currently where we are right now.
Omar, can you also talk about the Fannie and Freddie moratorium on foreclosures? How long is that continuing?
That I don't have the answer to. I'd have to get back to you on that one. I know there's still a lot of discussions of what's going to happen, because that might be part of what the president comes out with. So that's still very fluid and liquid, but I'll see if I can get some information on that.
And the foreclosure moratorium, is that in the HEROES Act as well, or is it just on
the
eviction?
foreclosure is in the HEROES Act, so that would extend it 12 months, and so it would be for any federally backed loan, right? So as long as there's a federal nexus, there's an eviction moratorium on it. So and that was clearly, well, that was part of the CARES Act, and what the HEROES Act is extending that one. So Fannie, and so that's where we are right now.
Omar, you indicated that the HEROES Act is about $3 trillion. What was the approximate investment they were looking at in the HEALS Act?
HEALS Act is about $1 trillion, so much more modest package. So we thought, maybe the sweet spot was around 1.5 trillion, which is still, historically, that is still a massive influx of money. And the way I look at this is we're still in disaster recovery. We are not looking at economic stimulus yet. We are, the way Congress is still looking at it is it's like in Florida, we're kind of used to it because of hurricanes, right? We're still in disaster recovery, right? That's how they're viewing this. FEMA is still in charge of many things. So that's why you're seeing, that's what you're seeing. This does not include infrastructure dollars or dollars for energy efficiency or your traditional stimulus package like President Obama passed, right after the financial crisis in 2008, 2009. So you think about it, 1.5 trillion is just another extension of everything that's gone on up to now, but we still have to go back to try and stimulate the economy. So I think it may still be $3 trillion, but I think the Republicans want to, parcel it out 1.5 now, 1.5 later on, where I think the Democrats want to just get it $3 trillion now and just have it go all the way through.
Interesting. So more or less trying to bootstrap things and keep things afloat for right now until we can actually focus on stimulus, perhaps after a vaccine or some kind of clear controls in place with respect to the scope of the pandemic.
Right. And infrastructure will be part of that. So for the real estate industry, just think about, lots of roads, lots of all building projects. CDBG will get a lot of dollars. So bridges. So just think of, all those massive public infrastructure projects. It will be a cornerstone to whatever the stimulus package will be.
Excellent. Great. Well, I wanted to begin there because, historically, it always seems though the consumer confidence in things, how consumers view what's going on in the world is tied to what they spend. And that's the trickle down to impact retail as well as impact the hospitality industry and how things go. I mean, we're in Florida and we're the home of the amusement parks with Disney and Universal and Busch Gardens, which have all opened up again. But I'm not certain how much people are comfortable in revisiting those just yet and how far that's affected things overall. David, when we kind of had our planning session, David Bevirt, you talked a little about the impact on the hospitality industry overall and where things are in terms of hotels now and what the prospects are for that turning around. Can you give us a little bit of insight in that area?
Sure. So I'll just speak to what we're experiencing in our development. We're fortunate in our development that we're under construction, and the only asset that we had two assets, really one and a half. We had delivered the renovation of the Tampa Marriott Water Street. So it's over 700 rooms, full renovation, and the impact was immediate, like most hotels. The good news for us, we did stay open with a small crew, and we dropped probably from in the 90s, 90%, and that hotel has historically performed very well. And we dropped down to, I don't know, somewhere around 10%. But the hotel next to us, Embassy Suites, had actually closed. So the impact that we felt was immediate. So yeah, hospitality, I'm just telling you what I'm reading in the papers. I've got, good friends at Marriott and they're projecting out, it's probably going to be 3 to 4 years before they get back to stabilization, just based upon the impact to hospitality, tourism, and so forth. For us, the other impact was on retail. So we had delivered Sparkman Wharf Park with our 10 shipping containers. They're very, very, very small restaurants, but 10 chef-driven concepts that were also immediately impacted. And then we closed down the park for a short period of time. So retail, as far as asset classes, retail and certainly hospitality have been the most affected at this point in time.
You're on mute.
I'm going to kick this over to David Blattner and to Jason. With talking about stabilization, a lot of times when commercial loans are structured, especially the construction phase or the startup phase, when you're looking to put the money together, one of those key factors that might change the interest rate or extend the term of repayment for a permanent aspect of the loan is reaching stabilization. How are you seeing what David just described in terms of impacting financing in hospitality in particular, and then retail sector for those kind of investment projects? Jason, want to go to you first, and then David Blattner he and I both work on loan docs.
David, why don't you start? Sorry, Michael, I couldn't hear the question for a second.
I was saying stabilization is a big part to the structure of a loan, commercial loan, oftentimes for a new project kicking off in terms of getting it in place and then turning it to a permanent loan. And David Bevirt was suggesting that we might be 3 or 4 years out in hospitality. How are you seeing that in the financing side of the hospitality industry and retail?
Sure. So we don't do a lot of financing of hospitality on our team, but Cushman certainly does nationally, and with hospitality and with frankly anything that is construction based or value add based. There's going to be more scrutiny by lenders on the ability to get it done, the timing of which to get it done, and the metrics by which stabilization rates, rental rates, things like that. So as with anything, lenders are being a lot more cautious, and it's created the cost of that money and the ability to get things done to be a bit more challenging, and certainly for hospitality.
David Blattner?
Yeah, from my standpoint, the last hotel project I worked on was just before COVID, which we closed a CMBS backed loan. I guess it was January, maybe it was December. And then this all hit. And that same client was looking at several other hotels as this hit and stopped. And I have to say, honestly, I see no activity in the hospitality area right now. So I can't speak to how lenders are looking at it, except to say that from my experience, lenders are not looking at hospitality loans. So I would say that as to your specific question, the answer is there is no answer, simply because they're not looking at these loans right now.
Doesn't exist at the moment.
I will say that I think David's right for the most part, but there are some. The cost of that money has gotten expensive. I was on the phone with a lender yesterday, not a bank. It's a high yield lender, and he told me and my colleagues that he had just signed up 2 hospitality. He didn't give me the details, but he just signed up 2 hospitality loans, and those interest rates were pretty high. But at least it saved the project and allows it to move.
I have a private lender who's been working with a hotel and country club for a year and a half, but that's private money, and it's a whole different different game.
So in the typical institutional type loans, that's really, and I've seen the same thing in my practice, there's been none of that in the hospitality side, but there is some private money out there if people feel the need to get it going. It's challenging, to say the least, in terms of how do you project that stabilization, when it's going to come out of it. So, and
it's not cheap.
Yeah.
What are you seeing on the brokerage side of things in terms of the impact of where things stand, the ability to get financing, how it's affecting deals?
I couldn't hear. Was that to me? You broke up.
Yeah, you, Lloyd, yeah.
Yeah, we're the owner user buildings. We're doing a lot of. We've recently gone on the contract with 4 or 5 user buildings, and I guess we're about to find out if that's out there, but I'm sure it is. I'm comfortable that, that's the one bright spot in the market, our owner user buildings. So I'm confident those will get financed. I was involved in a loan myself at the beginning of COVID, and it was a nightmare to get approved, but it was right at the beginning of COVID. And, but I think, lenders have gotten their feet, and they know what they want to loan on now, which was important, because beginning of COVID, they didn't even know what they wanted to loan on. So I think that in
terms of knowing what they want to loan on, let's flip over to the opposite end of the spectrum, because I think hospitality has been hit the hardest, but let's talk about industrial. What are you seeing in the industrial field in terms of how that's been affected, if at all?
We don't do a lot of hospitality, fortunately. So we went from very little to none on the hospitality side. I mean, everything I've read is hospitality is going to take a long time to come back. Business travel is not going to happen, may never come back to the extent that it was. And people are investing money elsewhere. Their discretionary dollars have gone into their homes, RVs, and other things. So it'll be a while before I think that comes back, at least what I've read, but we don't do a lot of hospitality.
What about on the industrial side?
Industrial's business as usual. There's a lot of product being delivered in South Florida and throughout the state. If softness comes, it's not going to be COVID related. It's just going to be from all the product that's coming online. COVID is actually increased the demand on industrial for sure.
So industrial has gone up. A lot of, probably I'm suspecting, a lot of last mile type warehouse space, so they can get the deliveries to the locations faster. Mini warehouse.
I mean, South Florida is very land constrained, so a lot of people went out and have started construction on projects that may or may not have had a market. But I think with COVID, they're going to end up with a market for it.
Well, some of the conversations that I've heard and seen relate to how some of the bigger box retailers are kind of reconfiguring their space and moving reducing the amount of public facing space and keeping the back room bigger, and instead of getting last mile warehousing, using that, even though retail space is more costly than the industrial space. Do you see any of that happening at this stage? Anybody on the panel?
I have not seen it in South Florida.
So I can tell you I can't get specific, but of several projects that are former bigger box retail projects, single tenant, bigger box retail projects. This is throughout the state that I see, and I know it's happening across the country, that are being reconfigured into industrial and being signed up into last mile space for big national tenants that use it. I'm not sure if we're supposed to say their names sometimes, but I think we all know who we're talking about. But not just that tenant, but several others. And our team, we've sold several of those industrial deals across the state and then Cushman across the country. And it feels like every other week we're seeing another one pop up somewhere.
You have a lot of zoning restrictions in South Florida that hinders that. Not saying that it won't happen, but hinders it.
Well, it seems to be somewhat of a natural fit, but for the zoning restrictions, because they've already got deliveries coming by semis and trucks to the big box locations to keep the inventory on the shelves. And if that changes, hopefully they can still have those trips, not put them out of compliance, and be able to move along that way and keep some things moving. In the middle of the spectrum, or maybe somewhere between hospitality and industrial, we also got the multifamily sector that's out there. Obviously, what Omar started off with and talking about with the moratorium on rents, Florida's governor extended the moratorium to the end of August here within Florida, and other states are following suit with that. One of the articles I read yesterday suggested that nationally, the rent collection rate is really only off about 4.5%, and they really haven't seen the flush out of people who have burned through their stimulus money. What are you all seeing? I know, David, your projects aren't online yet, but anything in your projections for your investors that you can see?
No, we've got three apartment buildings that are under construction. So we really don't have any data yet, because you don't open up your sales until you're nearing completion. So for us, we just don't have a lot of intel on that.
I'm involved in a 1,700 unit portfolio that's off about 10%, but it's been consistent. It went to 10%, reduced collections, and kind of stayed there.
And to answer David's question, Fannie and Freddie, August 31st is as far as they put the eviction moratorium. So when you're talking about what's Congress looking to keep extending, that's exactly what they're looking at.
I think what we're hearing both within Florida and nationally is that, it really kind of depends on the type of multifamily or the class of multifamily, where the class A's are really getting great collections, don't quote me on this, but like 95% plus, trailing down to the B's, and then the C's that are more like, 85% collections. And that sounds fairly good, but that last 15%, to landlords who have tighter mortgages, maybe over levered, it's pretty significant.
And so what do you think with the change of people's mindset and with respect to online? And I'm not just talking about online retail. I mean, right now I'm ordering my groceries online and going and pick them up from the store, just doing the curbside pickup. But the whole gamut of what's trade out there commercially for consumers has shifted, where everybody's got this greater acceptance of things. How are you seeing that online surge impacting the various sectors? And we'll talk about, if any of you all have any insight on the retail side of things to begin with, and the impact on the real estate side. Any thoughts?
A couple of retail centers we're involved with are not doing well. And we have a small center in Parkland. We don't have one tenant in the property paying full rent. But they're probably, they're not a good example of, I think lifestyle centers will come back with the Nike swoosh, but the rest of retail has probably changed for a while, forever.
Yeah. So I tell you, and it probably completely depends on the center. What you're describing is not the ordering online obviously is nothing new, and we've been talking about that for the last several years. COVID has certainly exacerbated that. But we're seeing we're seeing things across the board for some of our clients that are collecting 50% of their rents, 40% of their rents. But others, we're working on a few loans, one of which was like 85% occupied pre-COVID, lost 2 tenants, but others are mostly paying and, now, occupied a little bit less, but still a fairly stable or, lighter value add deal. Client of mine is also looking at another center as a potential acquisition, just 90% occupied, has some boxes, but more more recession resistant tenants, or hobby or not Hobby Lobby, like Goodwill and things like that. So to the extent that you have more recession resistant tenants and you have some lifestyle type tenants, it's just a matter of weathering the storm, and those centers might be fine. But you'll certainly see some stress on it. And I can tell you from a lending perspective, retail is just a bad word. And we're working on a few things now, but it's challenging. I think we'll get them done, but it's challenging.
Yeah,
So,
I think it depends on your landlord. It's interesting. I've been very busy with a couple small retail centers, bringing in new leases. These centers, one's new out of the ground, and one is just about CO'd, and they've been very busy with lease up. And the configuration is different than for both centers is different than originally planned. No restaurants. Originally had restaurants, but no restaurants. I have a third center that's coming out of the ground where there's actually absolutely no activity. So I think that it depends on the landlord and being flexible and being nimble. Shopping centers, malls, and closed malls, I think that's a whole different game. With the department stores, the anchor tenants filing for bankruptcy or closing their locations, they have to totally figure out what they're going to do, whether they're going to be lifestyle centers, whether they're going to be fulfillment centers, which you started to talk about, Mike, whether they're going to be reconfigured to be housing or entertainment centers. The enclosed shopping mall of the 60s, 70s, and 80s, or 90s even, that's going to be a thing of the past. But the strip centers, they're being nimble, and anything that's anchored by Publix is still going to come out. It's going to come out of it on the other side because Publix just draws.
Right.
But restaurant space is going to be hard to fill for a while.
Michael, I can, if you like, I can speak to office. Now, we don't, we have very little in the way of occupied office, but I've spoken with former colleagues at Brookfield in LA and New York and DC, and what we're learning is, and it's no surprise, is that the vast majority of the office tenants up front, early on in the pandemic, certainly had sought relief. And then once the landlord puts to them, what the requirements are in order to have that discussion, which is your financials and so forth, then that quickly, for the most part, it quickly went away. It also depends on the industry, whether it's the type of tenant, professional service, insurance, healthcare, whatever. So it's very dependent upon the type of business. But for the most part, that's what most landlords have experienced. It's a very different than the retail. I mean, retail, there have been extraordinary amount of workouts and discussions about cutting rent. And even if for an office tenant, to the extent they are provided some relief, it means free rent that will be repaid in the future. So it's upfront relief, but gets repaid on the back end.
Yeah, I've seen that. I've seen also negotiations where there'll be free rent, but an extension of the lease for a year or two.
Yep.
In exchange for that free rent. Variety of different approaches, but all that was relatively short term, meaning a month or two of relief, and the rest of it went back to normal, which we've already gotten to for most of the ones that I worked on early on. So in that context, since you brought up office, let's continue down that path for a few moments. And in the office space, you could pull up 50 articles on what's going to happen to the office sector, and half of them will say people are going to contract because they're so used to and working well, work from home and working remotely. And others are going to say they're expanding because they need more space to socially distance their employees. They can't create these pens with 15 people in a cube. And so in the context of each of you, I'll start with you, David. What are you seeing in terms of your tenants who are leasing up the new office buildings you have coming online?
Sure.
and go to the others in terms of what they're seeing for the existing leases that are out there.
So, out of adversity comes much opportunity for innovation, right? And I think that's a lot of what we're seeing. Nobody has the answers right now, but I can tell you we've formed a lot of opinions and observations. We're studying behavioral and operational shifts based upon COVID that will allow us to understand how we can make our occupants, our office tenant occupants safer and live in a healthier environment. I'd like to say we were, if you can't be good, be lucky. We started out with the well concept, working with the International Well Building Institute very, very early on, and Delos, our consultant, to develop what we're now the first pre-certified well district in the world with well-certified buildings. So that's what I mean. Out of adversity comes really some positives. So well will now become very much part of most tenants' narratives when they're considering their office space. How do you live different? How do you occupy space differently? And we were on a number of calls with our architects. We have Cook Fox is the architect for one of our buildings. It's a biophilic design for 1000 Water Street. And the other building is 400 Channelside. And that was designed by Gensler. And we've been on with the Gensler team and a little bit with Cook Fox to really understand the impact. And there are some shifts. We're going to see a little bit of base building shifts, but I'm going to say it's more operational. Distancing is going to be, very important, and our ability to accommodate them for distancing is going to be important within those buildings. It's really a function of their design. But the other is, I'll get back to the operational touchless environment. So getting from, I'm going to say your home into your car, onto work, into your office building, up into your office, back out to your car and home without having to touch anything, including the elevators, touch anything. So everything is by an app on your phone. Biometric scanners are being discussed. I mean, there are a lot of really smart technologies out there that we're considering. There are cost implications, certainly, from that operational standpoint. But again, it's really too early to say. We're studying a lot of these with the help of our consultants to really understand from a base building standpoint and from an operational standpoint what we need to do. And the bottom line is to make certain that our tenants feel safe and comfortable in our environment, in the business environment.
Yeah, Strategic Property Partners is a very interesting position because you started with the well long before any of this came along, and you're at the stage where you're almost ready to deliver to the market. So you have that flexibility at this stage to kind of make some of those changes for touchless environments and take advantage of the technology. But Lloyd or Jason, what are you all seeing on the existing office space that's out there in terms of those leases that are there? And are they?
Our B product has done very well. We've actually had net positive absorption in the B product. People looking for value and the ability to do shorter term leases is probably what drove that. We've had no activity until recently in A product. We're starting to get some showings and some activity, but it was crickets for several months for high priced office space. We haven't really seen people taking more space though than they had. They seem to be more convinced that there's going to be, a 2-day-a-week work from home type thing. We're working with one law firm who is actually planning to provide 3 offices for every 6 attorneys and let them check them out. See how that goes.
That's interesting.
People are being creative and looking for different solutions.
Yeah.
Actually, I'm hearing small law firms talk a lot about that.
Right.
Office sharing arrangements. I haven't talked to accountants yet, but I've talked to friends with small law firms, and they're talking about doing that on their next leases.
Right.
Yeah. The utilization. So David, to speak to that, if by example, what we talk to our architects, our architect consultants is, if any company, it doesn't matter if it's a law firm, an accounting firm, if they're going to have 20% of their staff working from home, then do they need 20% less space? And then, yes, perhaps, but conversely to that is with proper interior programming and distancing, if you want less open plan, you want more hard walls, then net, if you have to add 20% more, then it's a wash. And nobody has any data to prove this out, but those are the discussions that are being had.
Yeah, and you know, so just to add to that, first of all, you know, across the board with my clients, everyone's collections on office have been very good. Now, whether that's related to PPP or not, but like, you know, their collections have been very good. You know, there's all these questions about office. It's, you know, in my discussions with clients, with lenders, with investors, it's the one asset type that that no one can figure out yet, and probably we won't figure out, you know, for some time, as you know, as David just said, because you know, as he said, you know, will we need less space? Will we need more space? Like, you know, what's it going to be? And there's pulling forces in both directions. It's just going to take a while. And look, we're 4 or 5 months into something that will probably reshape our lives for forever, right? I mean, if you think back to 9/11, which was obviously very different, but something that traumatized our country, you know, greatly. The world changed since then. Traveling, you know, getting on airplane, we responded to it, but some of that just took time. We're 4 months into this, and you know, unless a business is failing, you know, office, retail, you know, you have longer term leases. So those decisions, they're great talking. Everything we're saying now, as David said, are great talking points, but those decisions will not be made until leases are up in a year or 3 months or 5 years or 10 years. And I suspect the world will be a very different place in a year from now, compared to how we're all kind of feeling and thinking right now about office. And the work from home sometimes feels good, but if you see me fidgeting a little bit, I've got my kids texting me and bothering me as they know I'm busy. So I personally can't wait to get back to work full time. And so, you know, we'll see how it all works out. But office is the one asset type that's probably the hardest to figure out. And I think will take the longest.
I keep hearing that everyone wants the ability to stay at home a day or two during the week at their option, but how that translates into the office environment and needs, I don't know how the math works.
And if that happens, you know, do you want somebody else sitting at your desk when you're not there, right? I mean, right. I don't, I want my desk nice and clean and sanitized when I get back. So again, there are pulling forces in both directions that, maybe it all evens out.
Well, touching on one thing that you mentioned a moment ago in terms of the leases and the renewals down the road and how long the leases are going to be, what are we seeing in terms of the renewals going on right now? Are they renewing their leases? Are they signing up for longer, or are they just trying to say, maybe we'll make a decision a year or two from now and pursuing a shorter term renewal?
A lot of short term. We've done a lot of short term renewals.
Across different classes of office space?
Yes. No one's making long-term commitments, especially in the office market, for the reasons we just talked about. They don't know what it's going to look like.
Yeah, we're seeing the same thing, Lloyd. And we're just the data that we're studying. Cushman Wakefield's reports that are coming out, which are terrific. If you look at absorption for the last quarter, a very high percentage were renewals, and it's very much a kick the can down the road mentality right now. People cannot make decisions, and I would suggest that going through the end of the year and into Q1 of 21, we're going to continue to see that. At some point, though, when companies reach what I'll call operational continuity, they've kind of settled into this new environment. They've gotten their staffing right. They've got their business plans. Then they can start to focus on other things like office space. So we're kind of projecting out that the remainder of this year is going to be figuring things out, and then hopefully, some aspects of business, including real estate decisions, will start to go into effect starting Q1 of 21.
Yep.
Very interesting. So also,
and by that time, I think we'll also have a better feel of when this all ends.
Yeah, I think there's a lot of factors between now and the end of the year, including how far along they get on the vaccine and how long that would take to deliver to the masses. And just like we've seen some of the changes with the testing that's gone on, but also the elections are coming up. And also there's a lot of changes that are coming about through a lot of the conversation that's now happening regarding social issues in our society, and all that's impacting how people are looking at things overall. So those would be all big impacts. David Blattner, going on the transactional side of things, landlords, as they're drafting their leases and looking at what's going on right now, are you seeing any different trends in what they're looking at? Because it would seem to me, from our previous conversation and talking with others that, you know, it's becoming a lot more important for the landlord to have a better understanding of what the tenant is doing as a business, so they can either convince a lender to lend or otherwise. What are you seeing in terms of that? Would landlords looking for more information from their tenants and their leases and the right to get it during the lease term?
Yeah, a few things. Number one, always have, you know, not that this is different, but the personal guarantee is as important as it's ever been. The landlords are asking, the landlords that I deal with anyway, are asking for a lot more information about the guarantor, the principal of the business. Certainly, they've always asked for this, but we're looking a lot deeper into who's really the money person of the landlord, of the tenant rather, and want to know who's the person who's actually going to be repaying if the tenant defaults. So the landlords are getting very, very concerned about the tenant's ability to pay the rent, and who's the person who's going to be the one who's going to be backing it. So that's very important. Number two, they're concerned about the experience, and I guess this does go to the guarantor, but the experience of the tenant and the tenant in the business that they're proposing to put into the retail center. So they're looking at not just the financial abilities, but the business background. And then the third thing that's come up, and I'm sure all of you would speak to this, is the tenants have asked for, and the landlords are no longer blinking at this, but a pre-negotiated reduced rent for the next government mandated shutdown. So we're not caught with an I don't know the next time that we're shut down, and everybody believes that there's going to be another shutdown for COVID. So the landlords have been quick to agree to some kind of deferred rent that is repaid at some point during the term of the lease, but the tenants want certainty to know that they are not going to have to pay full boat on the base rent anyway if they are forced to shut down again because of by the government because of pandemic related issues. So we've been drafting that into the leases almost as a matter of course now.
In retail.
In retail.
We've been getting that ask in industrial, but I haven't had a landlord agree to it yet in industrial.
Well, I think that industrial, as you said, is the strongest class. I haven't had to negotiate an office. I've actually had to do it once in an office lease, and it was a pretty landlord favored response where it was a short-term agreed for deferred, and it was fully repaid once the crisis was over.
I will say what a tenant does become very important in all asset classes. You know, industrial, nobody really cared what you did as long as it was a clean use. Now they really want to know what you do, and is it, you know, resistance to the pandemic.
I would imagine
and we have tenants wanting to know more about landlords now too. And there's
it's probably a good ask for the tenant to be making in terms of more information about the landlord and asking for these types of things that shows the landlord that they're planning and they've got the right business sense about how to not get caught short in the future and create some of that confidence that's needed between that landlord and tenant relationship as we navigate through all of this. Omar?
Yeah, I would just say that there has been no talk about shutting things down again. That's almost a non-starter. Everybody's like, we'll either do herd immunity or vaccines, but shutting down is not an option for, at least on the government side. You may have some local, you know, masks. I mean, they'll, you know, you may close down specific things like gyms, bars, things like that. But an overall shutdown, that is, I can tell you, that is for every politician I've heard of both sides of the aisle, that is kind of off the table. So
at the federal level.
Well, he deals with local too, but
no, at every level. I mean, we represent, like I said, counties and cities. So it's at every level. There's nobody talking about, you know, they may go after very specific things or reduce the amount of people getting together. Or they'll play at the fringes, but an outright, you know, shutting everything down, going back to pre-phase one. I haven't heard, you know, listen, there's an election coming in November. That's literally political suicide at this point if you're shutting it down. Because you've seen the numbers, everybody, any incumbent right now is getting shellacked in the polls. I don't care what party you're in. If you're the one being the decision maker and you're shutting things down, you know, as you open things up, your poll starts going back up again. So there's just no appetite for it. So everybody's just been told, figure this out, but we're not going back. School boards, you know, that's the other one. The school boards are shutting at least the schools down, and that's having that ripple effect. But as far as cities, counties, and the federal government employees are actually starting to come back. So,
and that's why I find one of your initial comments, Omar, very, very interesting. When you said, when your opening comments, that this is disaster recovery money as opposed to economic stimulus. It's like the only time that you hear somebody who works close to government not call this economic stimulus, because by not closing down, the money that we're talking about is economics is really reported as stimulus dollars and not as disaster recovery.
right.
So,
but they're looking at it more like a hurricane,
reelection.
Right? Yeah, to prop up businesses while they recover from their you know, whatever the disaster is.
I understand, but by not doing a shutdown, and I understand what you're saying, but people who, the small businessman and the landlords, they're all scared to death, notwithstanding what the politicians are saying, that because of the numbers and everything else, that there's going to be another shutdown. And some of the leases that I've done, nail salons, a massage envy type place, and those kind of things, are the kind of businesses that would be on the list to shut down temporarily. So that's why you would put those kind of clauses in there.
What I think is being worked on up here is, you know, extensions of the PPP loans, allowing a lot of those businesses to take a second bite of the apple, so they'll be able to do that. But I think the focus there would be to keep so it would not be a mandate to shut down, but it would be, what do we have to do to keep those businesses solvent until we figure it out? So.
Understood. Unless COVID-21 hits us next year.
Right.
With after COVID-19 vaccine works and the mutated virus comes around at the end in next fall. So just
Jason,
preparing.
Jason, we talked a bit about what the landlords are doing differently. From the lender's perspective, is the lender looking at things differently in the way they're underwriting their loans and looking for more detail, or is it have they already gotten to that mode since the Great Recession and not left it?
Oh, no. They are absolutely, look, you know, not unlike an investor looking at a deal, you know, lender is looking at every deal with more scrutiny and a bit more careful. And, you know, keep in mind, you know, a lender putting money into a deal just like an investor has downside that they want to look at. They don't have upside like investors do. They just want to collect their, you know, 3, 4, 5% or whatever the rate is and make sure they get paid back. So there is more scrutiny now. There's much more attention to tenants to the extent that they're available, which they're not always. They're asking for tenant financials. They're digging in as much as they can with tenants. And their underwriting standards, you know, may change a little bit. And certainly for value add deals, a little bit more if you're projecting a lease up of an office project or a retail center or whatever it is, you know, you're going to be a little bit more careful in terms of how quickly you think you might lease up at rental rates, and you know, things like that. And that, you know, and we've seen that, you know, that carefulness translate into, and like I said, for office properties, we still don't even know what the impact's going to be, if any. So, you know, so we've seen that translate in some cases into some lower leverage, not in all cases, but sometimes. In some cases, there are lenders who are just asking for, or asking and getting an upfront reserve or escrow for 3 months or 6 months of principal and interest payments, because they just want to get through the next few months and figure things will be better after that. So they're, you know, asking for, and in many cases getting that sometimes. So there are certain, you know, they are definitely being a bit more careful as they look at every single deal.
What about on the lower leverage deals that you're seeing going on? Interest rates are at a really low range right now. What are you seeing in that space where if a deal is not got relatively low leverage when you're starting out 50% or less?
Yeah. So, and it depends on whether you've got whether you usually you see lower leverage for stable deals and when you're, looking for, a lot of interest only payments and for a low rate. So I'd say for like industrial, multifamily, rates keep going down. I mean, we're seeing long-term rates on some deals at 50% leverage or less in the twos, mid to upper twos for 10-year money. I mean, it's crazy low. And even as you lever up a little bit, rates can still be pretty low if you have a solid project. Retail can be, in fact, we're still kind of in investigative mode for retail, so we'll see there. But for and office, rates can maybe not as low as industrial and multifamily. Everyone loves industrial right now, but even for office deals, when the leverage is low, rates can be pretty low.
So one of the questions that was asked by one of the registrants for today's event attending is, when will we see commercial assets being converted to entry-level home ownership for the stakeholders, namely the workforce support staff of corporations? So I'm going to kind of put that as an open question to everybody out there, because for example, locally here in Tampa, and in many places, especially where Sears was one of the anchors in the mall space, you've seen a lot of redevelopments of those mall spaces with housing of a variety of different types, workforce housing, so the workers can be near where they need to be and minimize the transportation impact and so on. What are you all seeing in that space? Is that still a concept that's growing, especially with the impact on retail that COVID's had? Any thoughts on that?
We're definitely seeing, NCAT or malls being converted to multifamily. We have a listing up in Palm Beach where it has a Sears and a Dillard's, and they're both dark. And we're selling both parcels off to different multifamily developers. And I don't know if there's going to be any retail left in that mall when it's done. But.
Interesting.
You have to be careful about that, because a lot of the malls around the country that have done that has not converted to workforce housing. It's converted into market rate and higher, sometimes luxury. So
these are both
a lot of these
great deals.
Yeah, a lot of these malls are in the suburbs and in higher end neighborhoods where they've gone dark. So it's a great concept, but the cities, the municipalities have to get involved and encourage the developers through incentives to have affordable housing components in there. I think it's a great idea to do it, and it should be a component of every one of these deals where the malls are being converted in a lot of places. But in most of these deals that I've read about, they're market rate and higher. They're high end. So and I know that the question probably isn't just about malls, but we're focusing on malls. Talk to your local officials about making sure that there's an affordable housing component in any deal that comes through your city.
David, what are you seeing in terms of the downtowns, David Bevirt? Seemed like the pressure was pushing everything. People were moving to downtown, abandoning the suburbs. Has COVID and actually not just COVID, but some of the civil unrest out there starting to push people back out of the downtowns? Are you seeing any concern about that in the multifamily sector?
No, it's way too early. I mean, again, since we haven't even delivered our residential, we don't have any basis for comparison yet, because we don't have really the numbers to compare. I will tell you, I was on a ULI panel this morning, and there was a discussion with our other fellow developers, Midtown and the development out there at the airport. And the good thing about Tampa Bay is with our growth is we have something for everybody, whether it's suburban or downtown. I think really the narrative is about even like a Midtown. It's even though it's a little more suburban, it's still a mixed use development. And for us, we're truly an urban development that there is a trend for people, in my opinion, to continue to move downtown, because we're looking at a walkable environment. So people getting rid of their cars. My son lives in DC, doesn't have a car, takes, Metro. It's an opportunity for companies and organizations to hire employees and suggest to them that you get Uber credits. You don't buy a car. We're going to give you Uber credits because, in what we're delivering, we call it a 15-minute city. Is that within 15 minutes you can walk just about anywhere, which means your housing, where you live, where you work, where you dine, where you entertain, hotels, etc. So to me, urban environments are very much in vogue and will continue to be. And what we're developing is I think is truly is very unique for the Tampa market, but it's also unique for the U.S. in some respects.
Jason, are you seeing anything on the lending side of things in terms of the multifamily we said is strong, but are they being selective in terms of the location with what's going on right now? Is there a push away from the cities, or is it not really evident?
Not really evident right now. I mean, there's talk and look, and South Florida is a little bit different, where there's, COVID aside, there's talk of, potential oversupply of, of some of the product in our, down in Miami and the areas around Miami, but not a major change. I mean, look, Miami, Tampa is, it's a very, is a big and diverse city, and what David's firm and his partners are doing is really transformative there too. But we're creating that live, work, play atmosphere that never existed before. But there's not really high traffic like you might see in New York or some other bigger northeastern cities. You don't have that congestion. Public transportation in New York, just for example, is like I don't know when anyone's going to get on a subway again. But down here, not that we have the greatest public transportation yet, but it's starting. Tampa certainly has some, and South Florida we're trying. But I don't think we have fears of there being way too many people in our public transportation yet. That really hinders it. So I think the story is a little bit better. We're not as congested as some other major cities. So no, nothing COVID related necessarily, other than talk and chatter that we're seeing.
Okay, so
that'll move people out to the suburbs in South Florida's value. I think it's not going to be because of COVID.
Okay, that's fair assessment. So overall, in terms of, we covered a lot of different market segments, a lot of different topics and reasons over as we've seen here. In the general sense, if you take hospitality, which seems to be a few years out, each of you all, what do you think is a general consensus for the commercial real estate market to be on the upside swing of things as compared to looking like it might be getting a little bit worse before it gets better? Is it going to be 3 or 6 months out, or you think it's going to be specifically tied to the release of the vaccine, and then we go from there after a period of months? And just 10, 15 seconds, each of you all. I'll start with Jason, and we'll kind of go around to each, and your thoughts on that, and we can wrap it up from there.
So look, I think it's going to be very much related to having a vaccine and therapeutics, and then just how deep, this everything that's happened has really cut into our economy. What happens to our unemployment? Once this is solved, right? Once we get to that new normal, beyond that, it's really going to be tied to that and what type of recession we're in or we're not in, I think.
Lloyd?
Yeah, I think it's going to be tied to a direct tie-in with schools, with the school system. When there's a comfort level of school boards to start letting kids back in, I think that's when you're going to start seeing, a lot of movement on employment, on people being able to get back to work, because right now there's just that kind of is stifling the ability for anything else to move on, because then you got to stay home and take care of your kids. So until that gets fixed, or somehow, through vaccine or however, they're going to start letting kids back, but that's going to be a crucial factor in all this.
Lloyd, your thoughts?
Just from a demand standpoint on the investment side, and we're still seeing strong demand. I don't know that leasing is going to keep up with that demand. It's, based on the low interest rates and so forth. But when it's solved, I'm a believer it's going to come back when it's solved. And it's just a question of whether rates keep up with the cap rates, which seem to still being compressed and so forth, with quality assets.
Bevirt, your wrap-up thoughts?
Yeah, I agree with all those thoughts. The vaccine is directly tied to economic recovery, but I will add about Tampa Bay is that I think we have an extraordinary opportunity here in Tampa Bay, that we're well positioned to weather the storm better than most, as Jason alluded to, a less dense market. What I learned in meeting with the Nashville Chamber, they mentioned in the Great Recession that they were the last in and the first out of that recession. I think we're poised for that because we come from if you look at the economic, our economic data before, late March, we were really from a position of strength as far as GDP growth and job growth and so forth. So that said, I think we'll be similar to Nashville 10 years ago, kind of the last in and first out. Also, we can capitalize on this, what I'll call the southern migration to the Sun Belt and down to Florida for companies and organizations that are looking to get out of tier 1 markets like a Boston, New York, DC, for a more favorable lifestyle environment, but also more favorable business environment. So I think we really have an opportunity to capitalize on this over the next 5 years. I do, but it's really tied to fixing, certainly getting the vaccine, having our economy pick up, and then continue with that trajectory.
Blattner, any final thoughts?
Well, I agree with what everybody's saying. I think that it is tied directly to the vaccine, but I also fear that if we don't solve the eviction and foreclosure issue, we are faced with what could potentially be a catastrophic housing crisis, which could send us spiraling back to a major economic problem, which could affect all sectors of the real estate market and the economy. It's not just simply extending and kicking the can down the road, extending the moratorium for a year. It's making sure that people have enough money to pay their rent and pay their mortgages, but it's also making sure that the landlords and the landlords in particular can continue to pay their mortgages during the moratorium time, and that they're not that they're not forced to institute eviction proceedings once the moratorium is lifted. So if we don't do something soon, and it's the passage of the HEROES Act is a good start, because there is money in that bill, I believe, to give the landlords some relief. So solving the potential housing crisis is going to go a long way to solving this real estate crisis that we're in.
Great. Well, thank you everybody for your insight today. I learned a lot through the conversation, and appreciate you sharing your insights with me and with the rest of the panelists, and of course everybody who signed in. Thanks again.
Thank you to Becker and Polikoff.
Yes, thank you for having us on.
Thank you guys. Well done.
Thanks, everyone.